Chapter 1. Understanding Liquidity, the lifeblood of financial markets. Introduction. Why liquidity matters. Imagine you're at a market to sell your bicycle. If many people want to buy bikes and they're ready to pay a fair price, you can quickly sell it without losing money. That's liquidity. Now imagine you're trying to sell that same bike in a small village where no one's looking for one. You either have to wait, lower your price, or give up. That's what low liquidity feels like. In financial markets, liquidity plays the same role. It's the difference between smooth trades and stressful delays. It decides how fast, how easily, and how fairly you can buy or sell something, whether it's a stock, a currency, gold, or even real estate. Let's break this down step by step. Point 1.1. What is liquidity? Liquidity is a measure of how quickly and easily an asset can be bought or sold in the market without affecting its price. If you can sell an asset quickly at or near its current price, high liquidity. If you have to wait a long time or lower your price a lot, low liquidity. Types of liquidity. Market liquidity refers to how quickly an asset can be sold on the market. Stocks like Apple or Microsoft. Highly liquid, a rare painting. Not very liquid. You might wait months or years to sell. Accounting liquidity refers to a company's ability to pay its short-term debts using its current assets. This is more about balance sheets, like cash on hand, accounts receivable, etc. In this book, we're focusing on market liquidity, especially in trading. Point 1.2. Real-life examples of liquidity. Example 1. The grocery store. You walk into a supermarket to buy bread. The store has hundreds of loaves and dozens of people buying. You buy in seconds, no price change. That's liquidity in action. Example 2. Selling a house. You want to sell your house. There are only 2 potential buyers in town. You wait months and maybe lower your price to get it sold. That's low liquidity. Example 3. Forex market. Let's say you want to buy euro to US dollar. The Forex market trades $7 trillion a day. You can buy or sell almost instantly. That's extremely high liquidity. Point 1.3. Why liquidity is important. Fast execution. You can buy or sell quickly without delays. Fair prices. Prices stay stable when liquidity is high. Low costs, lower spreads, the gap between buying and selling price. Less risk. You don't get stuck in bad trades due to a lack of buyers or sellers. Point 1.4. High versus low liquidity assets. Asset type. Liquidity level. Notes. Cash. Very high, instantly usable stocks. Blue chip. High, easy to buy, sell in seconds. Forex. Extremely high, largest and most liquid market. Real estate. Low, takes time. Paperwork involved. Art/collectibles. Very low, niche buyers. Unpredictable. Pricing. 1.5. Who creates liquidity? Retail traders. You and me, trading on apps like MetaTrader or Robinhood. Institutional traders. Banks, hedge funds, and large firms who make big trades. Market makers. Firms or individuals that quote both buy and sell prices, ensuring there's always someone on the other side of the trade. Think of market makers as store owners who always keep items in stock, so you can always buy or sell without waiting. Point 1.6. Liquidity in different markets. Stock market liquidity varies. Popular stocks. Apple, Tesla are very liquid. Penny stocks might not be. Forex market. Most liquid market in the world. Major currency pairs like euro to US dollar or US dollar to Japanese yen trade billions daily. Crypto market. Some coins like Bitcoin or Ethereum are liquid. Others have almost no buyers or sellers. Commodities. Gold and oil are fairly liquid. Rare metals or agricultural commodities may not be. Point 1.7. Factors that affect liquidity. 1. Trading volume. Higher volume equals more liquidity. More people buying and selling means easier trading. Point 2. Spread. The smaller the spread between the bid, buy, and ask, sell, price, the higher the liquidity. Point 3. Market participants. More traders, institutions, and activity equals higher liquidity. Point 4. Time of day. Some markets are more active at specific hours. For example, Forex is most liquid during London, New York overlap. Crypto is more active during weekends and nights. 5. Economic events. Big news, like interest rate decisions or elections, can increase or decrease liquidity. Sometimes everyone is trading, other times they're waiting. Point 1.8. The dangers of low liquidity. Slippage. You expect to buy at $100, but it executes at $102. Ouch. Wider spreads, more expensive trades. Delayed trades. You get stuck in a position. Manipulation. Easier to push prices around when no one's trading. Point 1.9 How to check liquidity before you trade. Here's a simple checklist. Factor how to check volume. See daily trading volume on your platform spread. Look at the difference between bid and ask. Order book. Check how many buy-sell orders are pending. Market news. Is there an event causing low activity? Time. Is it an active trading session right now? 1.10 Liquidity and your trading strategy. Depending on your strategy, liquidity matters a lot. Day traders, you need high liquidity. You're entering and exiting fast. Swing traders, still important. You're holding trades for days or weeks. Need smooth entries/exits. Investors, less critical short term, but still impacts how easily you can buy sell. Asterisk. Chapter 2. How the market moves on liquidity. Introduction. Liquidity is the fuel of market movement. Price doesn't just move randomly. It moves because of liquidity imbalances. Every candle, spike, and breakout you see on a chart is the result of orders being filled and someone stepping in with more volume. The market runs on one rule. Price moves to where liquidity is. Let's explore how that works. Point 2.1 What moves the market? The market is moved by orders. Every time someone places a buy order or a sell order, they affect price. But here's the twist. Price doesn't move because you want to buy. Price moves when your order gets filled. To fill your order, the market needs liquidity, someone willing to take the opposite side. For example, you want to buy gold at $2,400. The market has no sellers at $2,400, but has a cluster of sell orders at $2,403. Your order moves the price up to $2,403 to find liquidity, sellers. That's how price chases liquidity. Point 2.2 What are buy-sell orders really doing? Let's break down order types and how they use liquidity. Market orders. You want to enter right now. You take whatever price is available. Your order consumes liquidity. Limit orders. You want a specific price. You wait for the market to come to you. Your order provides liquidity, so every time someone places a market order, the price moves to match the nearest liquidity level. Point 2.3 Liquidity pools, where the market hides fuel. Think of liquidity like water pools under the ground. Price moves to drink from those pools. These pools often exist above highs, buy-side liquidity, below lows, sell-side liquidity. Why? Because that's where stop losses and pending orders sit. The market seeks stop losses because they're guaranteed orders, ready to be filled. Point 2.4 Liquidity hunting. The market's favorite game. Let's say most traders are buying gold and placing their stop loss below $23.90. That means a huge cluster of sell orders sits just below $23.90. A smart money knows this. So price might drop to $2,389. Take liquidity, trigger everyone's stop losses, huge volume of sell orders. Use that fuel to push the price back up fast. This is called a liquidity sweep or stop hunt. Point 2.5 How institutions use liquidity. Big players, banks, hedge funds, smart money, don't enter trades randomly. They wait for retail traders to commit. Identify where liquidity clusters are forming. Use large orders to sweep that liquidity and move the market. Their job is to buy low where others are selling, liquidity zone. Sell high where others are buying, liquidity zone. This is how they enter trades with minimal slippage and maximum volume. Point 2.6 Key liquidity concepts. You must know concept. Simple definition. Buy-side liquidity. Buy stops placed above high. Sell-side liquidity. Sell stops placed below lows. Liquidity. Grab sudden move to take out stop losses. Liquidity. Void area, where there are no orders. Thin trading zone. Liquidity zone. Price areas with many pending orders. Imbalance when supply/demand is not equal. 2.7 How price creates liquidity. Ironically, price creates its own fuel. Here's how. Price moves up. Traders jump in late and place stop losses below. Market now has liquidity below, so it returns there to grab it. The cycle repeats. This is why you see fakeouts and reversals so often. The market moves one way to trigger orders, then quickly reverses after taking liquidity. 2.8 Liquidity in different time frames. Liquidity hunting happens on all time frames, but it looks different. Higher time frames, daily, weekly, big liquidity zones, institutional orders, swing trade setups. Lower time frames, 1M, 5M, 15M, scalping liquidity, more stop hunting noise, quick entries/exits. No matter the time frame, price is always searching for the next liquidity magnet 2.9 News events and liquidity spikes. Major news, like interest rate decisions or CPI reports, create sudden liquidity injections. What happens? Volume spikes, spread widens, market rapidly grabs both sides. Buy-sell liquidity. This is why trading during news is risky, but also a chance to ride big moves. If you know where liquidity lies. Point 2.10 How to spot liquidity zones on a chart. Look for equal highs or equal lows. These are retail targets. Consolidation ranges. Liquidity builds inside gaps or imbalance areas. The market often returns to fill them. Order blocks. Zones where institutions previously entered. Smart traders don't chase price. They wait where liquidity is likely to be. Point 2.11 The psychology behind liquidity. Most traders enter late, use tight stop losses, place SL right under support or above resistance. Institutions know this. That's why price breaks support before reversing up, smashes resistance before falling. This isn't manipulation. It's just liquidity mechanics that if your SL is too obvious, it's a magnet. Chapter 3. How to analyze liquidity zones and trade with them. Introduction. Liquidity zones are not just lines on a chart. In previous chapters, we explained what liquidity is and how the market uses it. Now, it's time to turn that knowledge into actionable trading strategies. Here's the main idea. If you can spot where liquidity is building, you can predict where price is going next. Let's learn how to identify those zones and trade with confidence. Point 3.1 What is a liquidity zone? A liquidity zone is an area on the chart where many orders are likely placed. These include stop-loss clusters, pending orders, buy limits, sell limits, breakout traders waiting to enter, institutional entry/exit points. Liquidity zones are like pressure points. When enough orders pile up, price reacts. Point 3.2 Types of liquidity zones. 1. Buy-side liquidity zone found above previous highs contains stop losses of sellers and breakout buy orders. 2. Sell-side liquidity zone found below previous lows contains stop losses of buyers and breakout sell orders. 3. Internal liquidity builds inside a range or consolidation. Short-term scalpers trade within it. 4. External liquidity located outside the range. Price moves here for large breakout moves. 3.3 How to spot liquidity zones on your chart. White heavy checkmark equal highs/equal lows. 2 or more highs/lows at the same level equals obvious liquidity trap. White heavy checkmark wicks/rejections. Long wicks show that price tapped into liquidity and reversed. White heavy checkmark consolidation ranges. Sideways movement builds orders on both sides. Expect liquidity sweep before a breakout. White heavy checkmark news candles. Sharp moves during news often grab liquidity first before real direction begins. White heavy checkmark volume spikes. Sudden increases in volume equals liquidity being used. 3. For liquidity and market structure. How they connect. Market structure tells you where price is going. Liquidity tells you how price will get there. Let's break it down. Structure. Liquidity behavior. Uptrend, higher highs. Liquidity builds below higher lows. Downtrend, lower lows. Liquidity builds above lower highs. Ranges. Liquidity builds both above and below breakouts. Fake breakouts target liquidity before reversal. Smart traders don't just trade structure. They watch how liquidity is interacting with it. 3.5 The trap setup. Stop hunt reversal strategy. One of the most powerful liquidity strategies. Step by step. Wait for price to break a key high/low. Volume spikes. Stop losses triggered. Price immediately rejects, creating a fake out. Enter in the opposite direction. Target next liquidity level. This is a classic smart money move. Retail gets trapped. Institutions get in cheap. Point 3.6 The liquidity grab plus imbalance fill combo. This strategy uses liquidity zone as entry, trigger imbalance as target. Example. Price sweeps a low, taps into sell side. Liquidity reverses and heads back up to fill an imbalance. You buy after confirmation of reversal. Target the imbalance zone as exit. 3. 7 Liquidity and time of day. Liquidity isn't constant. Certain times are more volatile and therefore more predictable. Session characteristics. London open 3 to 5 a.m. Eastern Standard Time. High volatility. First liquidity sweeps New York open 8 to 10 a.m. Eastern Standard Time. Huge liquidity. Best reversals. Asian session. Low volume. Range building. London, New York overlap. Strongest market moves. Pro tip. Liquidity grabs often happen just before these sessions begin. 3.8 Combining liquidity with other tools. Let's enhance your analysis using popular tools. White heavy checkmark volume high volume equals active liquidity, being used low volume after sweep equals likely fake. Move white heavy checkmark Fibonacci liquidity often exists near 61.8% or 78.6% retracement zones. White heavy checkmark order blocks institutional zones that price often returns to white heavy checkmark fair value gaps imbalance zones that act as magnet for price. White heavy checkmark support and resistance not for entries, but to locate where others place stop losses. 3.9 Smart liquidity-based entry strategy practical setup. Let's build a simple strategy using liquidity zones. Conditions: market in an uptrend, price approaches previous high wicks and volume spike equals stop losses. Triggered steps: draw zone above the high liquidity zone, wait for sweep and rejection candle, enter short trade. Reversal: place stop above wick, target next demand zone or internal liquidity. White heavy checkmark win high reward, small risk. White heavy checkmark smart trades where institutions enter. White heavy checkmark clean, no indicators needed. 3.10 How to avoid liquidity traps. Here's how to avoid getting tricked. Trap: what to do instead: placing SL right under support, place it below obvious liquidity, entering breakout without confirmation, wait for rejection or retest, chasing price after large candle, enter only after structure confirms, trading without checking time, no when session starts. /in 3.11 Real chart example: Euro to US dollar liquidity sweep. Let's say you're watching Euro to US dollar. You see a double top at 1.0850, looks like resistance, price spikes above to 1.0862, triggers stop losses, big wick forms, plus bearish engulfing candle, enter short at 1.0855, target internal liquidity at 1.0800. This move is engineered by smart money. You're not reacting. You're anticipating. 3.12 Backtesting liquidity zones. To master this strategy, go back 3 months on a chart, mark equal highs/lows, consolidation imbalances, track how price reacts to those zones, journal the outcomes. White heavy checkmark builds pattern recognition. White heavy checkmark boosts your confidence. White heavy checkmark sharpens your entry/exit timing. 3.13 Tools you can use to analyze liquidity. TradingView draw zones, mark highs/lows, use volume profile and session tools. Bookmap advanced tool to visualize order flow and liquidity. MT4/MT5 use indicators to show liquidity levels. Smart money concepts SMC indicators, auto draw order blocks and fair value gaps. Chapter 4: How smart money uses liquidity and how you can. To introduction: from understanding to mastery. You now understand what liquidity is, how it moves the market, and how to spot zones where liquidity builds up. Now it's time to think like smart money and build a complete strategy around liquidity. Let's walk through how smart money manipulates liquidity, how to avoid retail traps, how to build your own trading system. 4.1 Who is smart money? Smart money equals professional traders who have access to large capital and advanced tools. This includes investment banks, Goldman Sachs, JP Morgan, hedge funds, central banks, big institutions. Their goals: enter positions without slippage, get in early, trap retail traders, and ride big moves. They don't chase price. They wait for retail traders to create liquidity and then strike. 4.2 How smart money creates traps. Smart money moves the market by creating illusions. Here are the most common traps. Trap 1: the fake breakout, price breaks resistance, retail buys the breakout, market reverses fast and hits their SL. Smart money sells into their buying pressure. Trap 2: the stop-loss sweep, price dips below support briefly, retail SLs are triggered, smart money buys cheap and pushes price up. Trap 3: news spike, price jumps during news, retail chases the move, smart money reverses the market after grabbing liquidity. These moves aren't accidental. They're engineered to trigger stop-loss clusters and generate order flow. 4.3 The smart money trading cycle: accumulate liquidity, price ranges and builds up orders on both sides. Sweep liquidity, price breaks out in one direction, hits stop losses. Reverse: smart money enters in the opposite direction using that liquidity. Expansion: price moves strongly toward the real target. You've seen this pattern thousands of times. It's the foundation of smart money concepts. 4.4 Why you must avoid trading like the crowd. Most retail traders buy breakouts, place SLs under swing lows, chase price during volatility, and what happens? Their entries are late, their SLs are easy targets, they get caught in smart money traps. Liquidity is built on retail mistakes. To win, you must trade where liquidity is taken, not where it builds. Point 4.5 Building your liquidity-based trading system. Let's build a clean, simple system. White heavy checkmark. Step 1. Identify structure. Are you in an uptrend, downtrend, or range? White heavy checkmark. Step 2. Mark liquidity zones, equal highs / lows, previous support / resistance, fair value gaps. White heavy checkmark. Step 3. Wait for liquidity sweep. Look for stop hunts or fakeouts. Watch for volume spike or wick rejection. White heavy checkmark. Step 4. Confirm reversal. Use price action, engulfing candle, pin bar. Wait for lower time frame confirmation. White heavy checkmark. Step 5. Enter and manage risk. Enter after confirmation. Place SL beyond the liquidity sweep. Wick risk only 1 to 2% per trade. White heavy checkmark. Step 6. Set realistic targets. Use next liquidity zone as TP. Watch for imbalances to get filled. 4. 6 trade example. Pound sterling to US dollar. Liquidity reversal. Price creates equal highs at 1.2800. Big green candle breaks 1.2800. Retail buys the breakout. One candle later, price drops back down to 1.2760. You enter short after confirmation. Target equals fair value gap at 1.2700. White heavy checkmark. Smart money took the buy side liquidity. White heavy checkmark. You entered after the trap was set. White heavy checkmark. You targeted the real magnet. This is liquidity-based precision trading. Point 4.7 Using multiple time frames. Use top-down analysis. Time frame purpose. Higher TF daily /4H. Identify major liquidity zones and direction. Mid TF 1H. Look for liquidity sweeps and setups. Lower TF 15M /5M. Confirm entries. Manage risk tightly. The higher time frame tells the story. The lower time frame shows the entry trigger. Point 4.8 Managing risk with liquidity in mind. Here's how liquidity affects your risk management. White heavy checkmark. High liquidity equals smaller spreads. Faster execution. Crossmark. Low liquidity equals wider spreads. Unexpected slippage. Smart risk tips. Don't trade right before major news. Avoid entering trades during holidays or sessions. Overlap gaps. Always use a stop loss, but place it beyond obvious liquidity. You're not just protecting capital, you're avoiding being hunted.